Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and how it could affect your investments. I'm Stacy Smith, and I urge that you subscribe or say that you like this podcast on whatever platform you happen to be using. Well, the markets have been volatile, quickly going from highs to lows and then back again. We'll discuss what is happening there. Also, we'll discuss the talk of tariffs and consumer sentiment and how that could affect your stock holdings. It's coming up on this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, Michael Godwin of Fergasso Advisors, and one of my regular panelists, Carrie Coghill, could not be with us. So joining us again is Shana Bielik of Coghill Investment Strategies. Shana, thank you once again for joining us. Appreciate you coming in. You know, what I like to do in this podcast is examining what is happening in the economy and the stock market and whether that could have any impact on your portfolio or investments. In the past 2 weeks, since the last time we met, the NASDAQ and the S&P 500 have not changed all that much, but the Dow has given up 2% of its value. Really nothing remarkable in what I just said, but what does make it a little perplexing is what happened in the previous 3 days of the last week, and that is on Wednesday, the NASDAQ, excuse me, flirted with its all-time high, and the S&P 500 did set a new closing high. But the markets declined on Thursday, and then on Friday, they suffered their worst one-day loss of the year, with the NASDAQ and the S&P 500 down more than 1.5%, and the Dow losing more than 2% of its value. And again, that's just one day. So you have all cautioned not to read too much of what happens on a day-to-day or even a week-to-week or sometimes maybe even a month-to-month basis. But I guess the question, Michael, I'll start with you. Is this just, again, another hiccup that's going on in the markets?
I think so, Stacy. It's a good question. I mean, again, I'm not going to prognosticate what's going to happen in the markets over the next week, month, even year. But what I do, I'm fond of saying that the markets can go up in really one of two ways. One is if the earnings of companies continue to expand, and the other is if the valuations or the price that investors are willing to pay for those earnings also go up. So we came into 2025 at very lofty valuations, meaning stocks were generally pretty expensive. And so when you have periods when the markets are very expensive, you're just going to have a lot more volatility going on in the markets and in portfolios, because really everything's going to be driven by what those earnings expectations are going to be. If a company comes out and thinks that they're going to guide a little bit lower, then not only are your earnings expectations going to come down, but because stocks are very, very expensive, that's probably also going to drop the markets a little bit as well. So I just think you're going to see a lot more volatility in 2025 than certainly we saw in 2024, and pretty much what we saw in 2023, which was very, very low and muted periods of volatility in the markets because it was a steady climb upwards. So this is really kind of unexpected. You shouldn't be really very surprised at what the market is doing on Friday. And I'd expect it more in 2025. I think, Stacey, when we came into the year, I said my highest conviction for 2025, my highest conviction thesis would the markets would correct at least 10% at some point in the year. So not that that's going to happen now, but I would be very, very hard pressed to say that we wouldn't see a big correction at some point, and a healthy correction at some point in 2025.
One of the good things, and I'll steal your thunder a little, Kim, the earnings have been coming in as expected, or better than expected more recently, as expected even as much as 6 and 9 months ago, which that's uncommon for earnings not to be lower than the optimists thought a year or so ago. So that being said, the market has some stronger fundamentals, but the headwind is interest rates. And right now inflation is sticky. A lot of what's happening is inflationary. Now, how that will play into the market will be, I mean, there's an offset with AI that might keep inflation down, and AI said no, it's impossible to measure what might happen. So I continue to be defensive.
Frank, you stole my thunder. You really did, because I was going right there, and that's interest rates. I think some of the freak out on Friday was caused by the whole, oh my gosh, the consumer is really concerned about inflation, and that's going to limit, all of this kind of good news that's come out so far about companies. Now, we're right now in retail earnings, and that really shows you the temperature of the consumer. For example, Walmart had really great results, but they are looking at kind of flattish, to down earnings and revenue for the next year. And I mean, they really are the broadest swath retailer, right? Because they serve pretty much everybody in the U.S., if not in other parts of the world too, but mostly the U.S. So that's giving us the temperature of the consumer. Now, I have been and continue to be a big bull on the concept of AI, but I'm starting to get sour on like the whole large language model, which I'm always been a skeptic about, because I still can't understand what problem it is that it is solving. So I don't know if it's worth it or not to put all these billions and billions and billions in. And I think that has really driven last year's market. Like almost all of the oxygen in the room was taken out by NVIDIA and the Magnificent Seven. And now I feel like the exhale is happening. And this week we get NVIDIA results. But I'm not sure I'm convinced that, data centers are going to cover the world. And whatever OpenAI is up to, that it is actually going to solve problems that people are willing to pay billions of dollars to access. So that's a lot, but I think we're at this always a turbulent time, but this could be a sea change away from OpenAI's concept of AI. How about that? That could be big for this year.
Could be. Shayna, your thoughts?
Yeah, but I agree with a lot of what was said, and we talked a little bit about this in the last segment about more of this whipsaw-like environment with the market, and there were some headlines, some economic data last week. Markets took a bit of a tumble. This morning they sort of reversed themselves, and some of them are back in the red. But I just think that this is more likely, to Michael's point, get ready for a bit more volatility than we've seen. We talk about 10% corrections being healthy. We didn't see one the last year. So, it's really just talking to clients and letting them know that, sure, there's some volatility, but let's stay focused on the long term.
All right, do all of you, any of you think we're just going to go in one of these sideways markets for some period of time then?
Yeah.
It depends on your definition.
It's tough to say. I think I'm going to go back to the AI stuff that Kim brought up real quick, Stacy.
Sure.
I mean, the market has become so concentrated in these top 10 names, and they're very, very heavily driven by AI. And I think that's kind of a concern right now, especially with, we don't know what's going to happen with DeepSeek. We talked about that a few weeks ago, but
Right.
Kim could probably talk to this better than I can. Microsoft is really paring back on some of its data center leases right now, and now they're, analysts are concerned that maybe data or AI has just gotten sort of overextended here. And if that's the case, these big companies, these NVIDIA's, Microsoft's, all the companies that are really tied to AI could kind of drag down the market a little bit. But I also think investors really have gotten away from page one of portfolio management or finance 101, which is diversification. We're really seeing finally the international markets do the heavy lifting here from a return standpoint. Europe and emerging markets are really doing pretty well compared to the U.S. markets now. So while AI and large cap U.S. stocks might come under pressure, it's really important, I think, as we progress into 2025 to maintain a diverse standpoint on the equity markets.
All right, let me throw this one out to you. I find it interesting. I think it was Frank, you brought up the interest rates. But, and I know you don't like to give much credit to the media and what they report on, but
I do that more because you're here.
I know that. But, if you hear and read a lot, we're talking about tariffs as well. None of you have mentioned that I can remember saying so far today. So is that playing a role in this or not? Michael, I know last week you said you're not going to change anything as far as how you view it on talk of tariffs. But when we also take a look at it, and then Bloomberg had this, and that is that the smaller companies are concerned. And according to Bloomberg, smaller firms say they are raising prices or freezing expansion plans, or they plan to take a hit on profit margins because as the price of imports climb, because they cannot readily change their supply lines. Anybody want to comment on that at all? I mean, is it more interest rates or tariffs playing a part in this talk of tariffs?
It's important. This is why inflation is sticky. This is why we're concerned about it. And if Kim's right, AI is not going to keep inflation from running away again. And I mean, there's plenty to be concerned about.
Yeah.
And I can remember for most of my career when everybody was worried about whatever, because there's always something to worry about, usually many things, and right now there are a lot of things to worry about. And with that being said, markets have a way of climbing the wall of worry.
Yep.
If the fundamentals are strong. So that leads us to, are the fundamentals going to remain strong? And that's the overriding question right now. 24 was great. Well, it's over. Now what?
I'll dive in. I have about half of my main portfolio in small caps, or they're actually mid caps, like not anything below, $1 billion is way too small. So these are medium-sized companies in my view. Anyhow, I think a lot of them are worried about tariffs, but the stock market is way more worried about tariffs. And as much as I hate to kind of point fingers, but I think a lot of professional investors are just straight up lazy. And why do I say this? Anytime interest rates are going up, they want to throw every single small cap out. And that counts for tariffs too, because that's raising the cost, on these smaller companies. And here's the theory. A smaller company has a smaller footprint and a smaller balance sheet, which is probably more highly levered with debt. So you hear about this probably and maybe and all this kind of stuff. Not every small cap company is, just serving the US and has a lot of debt. But it doesn't matter. On days like Friday, investors turn and they just start getting rid of things indiscriminately, not really looking at each and every holding. And maybe this is the world of ETFs that we live in, that people are playing larger bets and going, small companies, debt, regional access. Personally, I love the small companies that have a niche idea that serves the world. So they might be in a smaller industry, but it, is global. So don't throw all those small companies out quite yet.
I have to ask this question, Shana. I'm sorry. You want to comment on that first? If tariffs are imposed, who does it really hurt? You hear that it really hurts the consumer. Does it really hurt the business at all, the corporation?
I suppose it depends if they decide to eat the cost or pass it on.
Okay.
So, it's every company I think is going to treat it a little bit differently. I think that's why just generally thinking about tariffs and kind of having this more of wait and see approach. When Trump first talked about tariffs, it was, a lot of focus on drug trade and immigration. And so I think just giving this a bit more time to play out to see how it really will impact the consumers, impact the market, to see how long it's going to stick around.
I think the tariff talk, and to Shana's point, you have to wait to see how it plays out. I still think it's going to be more bark than bite in the long run. Will there be tariffs implemented? Absolutely. Have we already seen it happen in 2018, I think he started doing it? Yes, the markets took a dip, but then they recovered a bit. We kind of already know the playbook to an extent, but I just think it's going to end up being more bark than bite, and companies and the U.S. consumer end up kind of figuring it out a little bit. And Trump's not, for all, whatever you feel of Trump, he really, really cares about how he looks. He really cares about what the stock market is doing. He really cares about how, his perception in the media, for an extent, is as well. So they can figure out ways to implement these tariffs without really hurting the consumer to the extent that we might think the consumer might be hurt as well.
There's also a theory out there that the tariff talk is merely talk, and it's a negotiating ploy to get what he wants. I mean, as an example, with the Ukraine, he threatens shutting them off and negotiating with Putin, and in another room, he's negotiating a minerals deal so that he can get some minerals out of Ukraine as payment for the money there he's going to give them so they can fight the war. What's really happening there? Your guess is as good as mine, but it seems like there's what it seems to be is not necessarily what it is.
And to maybe wrap this all up, or maybe this is just a discussion we're going to have for the next 4 years, I agree with you, Frank, wholeheartedly, and you, Michael, that this is a lot of this is a negotiating tactic, and we don't really know, other than America First, what the goal is. And it's really hard as an investor, again, because most of the companies that are public companies are global companies. We don't know how this is going to affect anybody, but it gives a whole lot of more uncertainty, which is going to drive volatility for sure. And I recommend you to have a longer term time focus on any of this stuff. And I don't care if you're doing asset allocation or picking individual stocks. Having that longer time period is going to let you smooth out those bad days, which are good days to buy, right? But you know, don't overly buy in emotionally to these markets. That's our takeaway here, maybe. Ever. Yes.
Easier said than done for some people, I have a feeling. But
But that's why we exist.
exactly, that was just what I was going to
We
say.
exist to walk people off the ledge, and let's look at this rationally. All right, and it's our job to keep it under control and help our clients do the same.
Good. I want to maybe wrap this up with this to tie in a little bit about interest rates. If tariffs are imposed, then that also raises red flags that we could see higher inflation. Am I right in trying to wrap this thing up, is what you all have said?
Yeah, among other things.
Yeah, well, among other things, right. But I want to go back to the consumer as well. And Kim, you kind of touched on this. The latest survey, I guess, was on Friday, which sent the markets tumbling a little bit. Consumers expect for the next 5 to 10 years 3.5% inflation. And also retail sales were down month to month. However, they were up year to year on a comparison basis. But if consumers are expecting to see inflation, and as you mentioned, Kim, Walmart is cautious, is there reason to be concerned, or could this just also be one of those self-fulfilling prophecies?
Gosh, I wanted to talk about this, but now I don't know that I do. Okay, so inflation, where does it come from? It's a mystery to many people. A lot of people on financial network TV, they'll just go out there and they'll tell you exactly where inflation is from. But I have to tell you, there are many, many causes of inflation, and some are more insidious than others. Now, you have brought up expectations. You know, when I first moved into this industry from being a software engineer, I'm like, ooh, who cares about expectations? Because, you know, we have the real world and we have what people want. Why are we even talking about this? Well, as you point out, Stacy, sometimes expectations can be a fulfillment, right? If people expect a recession, they stop spending. You know, they prepare, they batten down the hatches, and because they're not spending, you know, companies don't earn stuff, they have to lay people off, and it's a self, you know, defeating kind of cycle there. Now, I'm going to pose something that I feel kind of crazy talking about, but I think the inflation, other than the really short blips where we have supply and demand seriously out of whack for one or two little items like, oh, I don't know, the chips that were needed to complete a car to be rolled out and to be sold, like that is, of course, inflationary. But in the longer run, what I really think causes inflation is growth in money supply. If you look at M2, and yes, I'm wading into the weeds of where you, as the listener, you go to the St. Louis Fed and you look for M2. You could just type this into any Google kind of search engine, and you will see that M2 really preceded the growth in it, inflation. And why is that? Because the government was giving money directly to people through PPP, through enhanced unemployment. All of this stuff came from the government. Now this time, I'm unsure if the government is going to create debt and then shove it out the door. Now we can talk about creating debt doesn't necessarily, on the government, create inflation. Because if you look from 2009 through 2012, where we created tons of debt to help banks live through the real estate debacle, we didn't get inflation, although a lot of my brethren were forecasting inflation. Why not? Because that money just sat on bank balance sheets and the Federal Reserve. Once the government starts giving people money, that's where inflation comes from. And so if you watch M2, you can see what happens. Now, your guess is as good as mine about what the Trump administration is going to do about sending people money. I don't know. I have no idea. But if that dries up, then I think expectations for inflation could fall as well. And I feel like I've put a landmine off or a hand grenade, so I'm going to be quiet now.
Let me add to what you're saying, though. When the government pumps money out the way they did during the pandemic, in giving it to us, we spend it, which creates more demand than often there is supply, which is what also creates inflation as a basic just supply-demand equation. And then we run into we had the supply chain issues that reduced supply, all right, which created inflation. And I think all of that stuff is over.
Yep.
The article that was in this morning's paper where 50% of our spending is the top 10% of the people, or whatever those numbers were, that tells me the other 90% of the people are not growing their spending, which is not a demand, an excess demand issue, which might slow inflation down maybe.
Right.
And to add to it, I'm seeing $150 and $60 lease deals from car manufacturers, which tells me there's a lot of cars hanging around out there.
Yeah.
I want to bring this up as what you just mentioned, Frank, and that is an article in the Wall Street Journal on Monday, February 24th. The U.S. economy depends more than ever on rich people. The highest earning 10% of Americans have increased their spending far beyond inflation. Everyone else has not. The top 10% of earners, that's households making $250,000 a year or more, they can now account for 49.7% of all spending. 3 decades ago, it was 36%. And according to Mark Zandi, the chief economist at Moody's Analytics, is estimating that the top 10% alone accounted for almost 1/3 of the gross domestic product. Comments?
So, Stacy, think about these people that are making this category of over 250,000. They've had the liberties to save more, and they've had the benefit of the market going up the last 2 years.
Yes.
So they have a lot more money to spend than the average person. To kind of tie this back to your Walmart comment, I heard that their growth from last year in 2024, like 75% of it was from consumers who make about over $100,000 a year, and that's not their typical consumer. So if Walmart is now catering to, all scales of wealth, and if they do in fact see signs of slowing, that could indicate, it's about the consumer. And we talked last week about consumer sentiment and how they feel. What we're seeing now is out of consumer spending, looking at the numbers now, how are they acting? That's really important moving forward.
Mm-hmm.
Yeah, to that point, also, as the article wrapped up, it said that it noted that Big Lots filed for bankruptcy last year, Kohl's and Family Dollar are closing stores, and they're all battling for fewer dollars, i.e. the stores that kind of cater themselves to the people who are not making $250,000 a year or more. So I guess my question with all of this is if we start to see a downturn in the markets and the holdings that people have, that could really have a major impact on the economy if these analytics are correct. Am I right?
Yeah, I think we're looking at is the consumer starting to slow down. And I'm not suggesting that that's happening now. I think, again, we need more data. I don't think this is imminent signs of recession, but it does tell us a lot about consumer behavior. And if consumers do start to spend less, that could impact markets to the downside even further.
One area that I kind of track is home furnishings, because usually that goes up when people are buying new houses, right? Your old couch doesn't fit the new house, right? And oddly enough, even though housing is pretty low right now, home furnishings have been on fire. And that's kind of a conundrum for me. And maybe it's those high earners just going, I hate this couch, I want another, or whatever it is. Like, I just pick on a couch. But that is showing that very discretionary purchase, because I don't know that we all need another couch. That is going on. So that is a healthy consumer at some point. But I mean, these are just the weird things we all watch, right?
Yeah.
There's nothing weird about it.
Well, we're almost out of time here. We're getting late, so I was going to bring up about the housing market, mortgage rates, where things stand, and Wall Street Journal article also indicating that perhaps things are starting to tip on the side of the buyer now. Maybe we can have just a couple of seconds or comments on this if anybody would like to, or we can save it for the next time.
I'm seeing more houses on the market that aren't being snapped up. I, again, watch this. Like, I love Zillow. You can see how many houses, how long that house has been on for sale, what the price is, like what the price cuts are. I think it is turning in the buyer's favor. Now, hopefully those entry-level buyers start to get some supply on. Where it's coming from, I don't know.
Yeah.
Or what?
I saw-
One
there's a
thing that
couple-
I've noticed is that 6-9 months ago, when a house in my neighborhood came to the market, and of course the neighborhood knew about it before it was in the paper, we would hear it was sold before the photographer got there to take the pictures and put it on the line. I mean, they were going, now my next door neighbor sold his house. It took him 2 months, which isn't long by any stretch, but it took 2 months.
And that's
I have
beginning to
another
be
friend in another development that's had his house on the market for 6-7 months, and he's hardly getting a nibble. So it's, things are changing. Now, why he's not getting a nibble, I have an opinion, but I don't want him to hear this.
Michael, you were going to say something.
Yeah, I mean, I think there's still a problem with mortgage rates
Yeah.
still very high at 7%, which is still very high. And I saw, I read this like a week ago or so, the median purchase of a home, the median age of somebody buying a home now is 56 years old. That's what it hit in 2024, which is absurdly high. In 1980, it was 31. That was the average age of a person buying a home. Today, it's 56. So a huge cohort of people are just still priced out of the market right now. But to Kim and Frank's point in terms of houses being on the market longer, you're going to start seeing that in pockets of the U.S. You're really starting to see that right now in Washington, D.C., with a lot of the layoffs of federal employees. So that's going to probably spread to Maryland, Virginia, etc. So as those markets stay on the market longer, or those houses stay on the market longer, that could spread more regionally and maybe nationally at some point too.
Yeah, and the only thing I'll add is a buyer myself out there looking, who is always looking at Zillow. As it relates to mortgage rates, I know that they've been extremely high, but actually rates currently, I get a read on this every Monday, they've hit the lowest level that they've been in 2 months. Now, there's not 3%, right? But maybe they're dipping a little bit below 7%. And maybe that will spur some activity. Spring is hopefully springing soon. And, that tends to be an active time. But I agree. I'm seeing them. They're sitting longer. Prices are dipping. So maybe inventory is still an issue, but maybe some of us, including me, can get out there and snatch one off the market.
I'm going to throw this out. I don't know if anybody has an answer to this or not. How much does transition from somebody moving from one city to another city impact housing sales. I don't know if none of you, I suppose, are
No,
experts
but
in this area.
I was reading an article, Stacey, that talked about like transition. Either like somebody went through a divorce or somebody
yeah,
is
yeah.
forced to move due to they've lost a job or transitioning jobs. I know that if you want to move to Naples, there's a ton of houses in Florida that are available, but that's a different discussion because that's a homeowner's insurance dilemma
Yeah.
there.
Yeah, we talked about insurance one
Yeah.
other time. I'm not sure we're going to bring
Right.
that up again. So, all right, thank you guys. We'll continue our look at at investing in the economy in future editions. And again, I ask that you hit the subscribe or the like button on whatever platform you happen to be using to watch or to listen to this podcast. But right now, thanks for joining us, and we'll see you again in about 2 weeks.